We are looking at Veritone Inc., ticker VERI, which is currently sitting at $6.25 a share. That is down 12 cents, or 1.88% so far in today's session. And right away, that price tells a fascinating story, one that cuts directly against the grain of the dominant market narrative. The expectation, when you hear Veritone, is to immediately think artificial intelligence. The mind conjures images of rapid growth, software-like margins, and a stock chart that only goes up and to the right, mirroring the giants of the sector. The common belief is that Veritone, with its AIware platform, is a pure play on the AI trend, a specialized toolset for enterprises that want to harness this new technology. But the reality is what you see on the screen: a $6.25 stock, a market cap of just 45.68 crore, and a 52-week range that stretches from a painful $1.22 to a hopeful $9.42. This is not the chart of a stable AI behemoth. This is the chart of a battlefield. Today's intraday action is a perfect microcosm of that battle. The stock opened at $6.29, which was already a gap down from yesterday's close of $6.37. It immediately tried to rally, hitting a session high of $6.33, but was squarely rejected. That rejection was swift, sending the stock tumbling down to $6.06. Buyers stepped in at that level, and for the last hour, we've seen this slow grind back up to $6.25. This isn't calm institutional accumulation. This is volatility. This is a fight between short-term traders, long-term believers, and short sellers, all trying to find an equilibrium. The failure to reclaim the previous day's close is a sign of technical weakness, suggesting that sellers are still very much in control of the tape. This price action isn't happening in a vacuum. The broader macroeconomic environment is a brutal headwind for a company like Veritone. With interest rates remaining elevated, the market has zero patience for companies that are not profitable. We can see it right on the data. The PE ratio is a dash, meaning negative earnings. The dividend yield is a dash, meaning the company is not returning capital. It is in full-on growth or survival mode, reinvesting every penny. In this high-rate world, speculative tech with a promise of future profits gets punished, while companies with solid cash flow now get rewarded. Veritone is firmly in that first category, and its stock price reflects that pressure. This brings us to a critical and often overlooked part of the Veritone story: the short sellers. A stock risk volatile, with a public-facing AI narrative but a difficult financial reality, is a magnet for short interest. The short thesis is straightforward. Veritone is a cash-burning entity in a field dominated by giants. How can a 45 million market cap company truly compete against Microsoft's Azure AI services, Google's Vertex AI tools, or Amazon's AWS AI tools? These cloud giants can bundle transcription, translation, and object recognition services for practically free with their cloud storage, while Veritone has to fight for every single contract to prove its platform's value. Shorts are betting that the cash burn will become unsustainable, leading to more shareholder dilution through secondary offerings, which would send the stock price spiraling back toward those $1.22 lows. For investors, it is vital to know how to track this. This isn't about hype, it's about data. You need to be looking at the bi-weekly short interest reports from NASDAQ. Look for the total percentage of the float that is short. Anything over 20% is considered extremely high and signals a major battle. But don't stop there. You must also check the days to cover, which tells you how many days of average trading volume it would take for all the shorts to buy back their shares. A high number, say over 5 days, can be the fuel for a short squeeze if the company delivers good news, as shorts scramble to exit their positions. Another key metric is the borrow cost. This is the interest rate shorts must pay to borrow the shares. If that rate spikes, it means the supply of lendable shares is drying up, and it's becoming very expensive to maintain a short position. Your broker's active trading platform may provide this data. What's your take on the rising short interest? Smart money or manipulation? I'm curious what your perspective is. Comment below. This data is what separates responsible investing from gambling on a squeeze. Chasing a squeeze in a stock like VERI is playing with fire. That 52-week low of $1.22 is a stark reminder of the potential downside if the short seller's thesis proves correct. So what does Veritone actually do? Let's clear away the hype. The company's core product is AIware, which it positions as an operating system for AI. The idea is that instead of a company trying to build its own AI infrastructure, it can subscribe to AIware. The platform then acts as a hub, allowing the company to plug in hundreds of different AI models, from Veritone's own to an open-source model to a model from Google or Microsoft. Their main target markets are media, government, and legal. For media, AIware can automatically scan thousands of hours of video, creating metadata, transcribing audio, and recognizing faces. For government, it's used for tasks like redacting sensitive information from police body cam footage. In legal, it helps in e-discovery, sorting through millions of documents for relevant information. The business model is primarily software as a service, based on subscriptions. This is what gives the bulls hope. If they can achieve scale, the recurring revenue could be massive. Their last earnings reports have followed a familiar, frustrating pattern. Revenue growth that often looks decent, beating Wall Street's top-line expectation, but losses that are wider than anticipated. They are spending heavily on sales and R&D to acquire that revenue. This is the central conflict. The bulls see the revenue growth and platform adoption as proof the model is working. The bears see the widening losses and cash burn as proof the model is unprofitable and unsustainable. On social media forums and X, you see this war play out in real time. The bulls will point to a new government contract or a media partnership as a sign that the tipping point is near. They'll argue that Veritone's best-of-breed integration approach is superior to being locked into a single provider like AWS. The bears will post screenshots of the company's cash flow statement, highlighting the quarterly burn and warning of an imminent secondary offering. The reality, as is often the case, is somewhere in the middle. The platform is a real, functional piece of technology solving specific business problems, but it is doing so in an incredibly hostile, competitive, and economic environment. Looking forward, the catalysts and risks are perfectly clear. The bull case catalyst is a major, unexpected contract win. A large federal agency signing a multi-year, 8-figure deal. A massive media conglomerate like Disney or Netflix adopting Veritone as its global standard. Another catalyst would be a surprise move to profitability, proving they can control costs. And of course, there's the buyout possibility. A larger tech firm like IBM or Oracle could decide it's cheaper to buy Veritone's tech and customer list than to build it. Comment below on what you think is Veritone's biggest hurdle: competition from big tech or their own cash burn rate. What investors should be watching next week are the technical levels. That $6.06 low from today is now the critical short-term support. If it breaks, a retest of $6 or lower is likely. On the upside, the stock needs to reclaim the $6.37 previous close to show any sign of strength. We also need to watch the options chain. A sudden surge in put option buying would be a very bearish signal, suggesting smart money is positioning for a breakdown. In the end, Veritone embodies the core tension of the 2025 market. The expectation is that AI is an unstoppable force. The reality is that the business of AI is incredibly difficult, expensive, and competitive. The market wants to believe in the $9.42 high, but the balance sheet and the chart's technical weakness keep pointing back toward the $1.22 low. Today's price of $6.25 and its 1.88% drop simply shows that in today's trading, the skeptics are winning the argument. This isn't a set-it-and-forget-it AI play. It's a high-risk, high-reward speculation on one company's ability to survive a war against giants.